So, as we are waiting for Jordan, I know he was talking with an AE or an underwriter. I can't remember. Oh, there he is. Right on. Uh, so, today's topic, today's topic is 7 non-QM mortgage options you should know about to sell more homes this spring, summer, fall in your career, generally speaking. I promised 7 as I built out our little slide deck. We'll probably give you at least 9, So under promise and over deliver. That's always a good principle to live by in business. And this is just to give you a taste of them. And so I'll say right up front here, if you'd like more information about any of these, you can get back with Jordan or I, and we can explore in more detail. And if you have a scenario, a particular borrower or client that may fit into one or more of these possible boxes, then we'd love to explore that with them as well. We do like to make these as interactive as possible. So if or as you have questions, you can pop it in the chat or the Q&A box, whichever you prefer. And we are recording this. We are live streaming this. And we've set it up so that it will be available immediately after on demand if you miss it live or you want to check it out a second time and dig in a little deeper. The reason why, not the reason, a reason why I chose this topic for today is it relates to what just happened with NAR settling. And here's what I mean. I'm sure all of you listening here are aware that NAR, the big NAR settlement, $418 million paid out over 4 years, and it's going to drastically impact the way buyer agents, buyer brokers are compensated on transactions. And one of the strategies that I've heard over and over from industry experts, and we even shared yesterday on the show, for protecting your compensation as a buyer agent, a buyer broker, is bringing real value and service to the transaction. Well, what better way to bring real value and service to the transaction than to provide options to borrowers who didn't know they could qualify, or maybe had even been told in the past that they did not qualify. And so these programs are a great way for you to proactively address what's happening and go out and actively serve pools of clients in your market area that are either underserved or not being served at all. Okay, so this is a wonderful way for you to provide real value and service in your market and thereby protect your commission and not just protect it, but justify the commission that we are paid. Because that's the reality of what this comes down to is, can you justify the value you bring to the transaction versus just saying, well, it says in the MLS that that's what I get, so that's what I'm going to get, right? So that was the reason why I chose this topic today. I think it's a great opportunity for you to, you might pick one of these and choose for that to be the niche that you serve in your marketplace and build a database around and an entire business around. And not only that, on the real estate side, but one of the things that the activity has picked up greatly since the settlement for us is people interested in our dual license program, which you can scan that QR code. And so not only could you build, your real estate business around serving one or more of these niches, but you could also create an additional revenue stream if you are dual licensed. So that was a long way to tee up today's topic. But Jordan, good to see you. Yes. And I did put together just some very simple slides to keep us on topic and on point here. As I'm bringing this up, Jordan, we mention this often, but I think I think we can't mention it enough. But anytime we're talking about financing, we need to unpack the three pillars
Yeah,
of any mortgage transaction. So those three pillars are what, and then we'll try to relate the pillars to some of these different programs as we unpack them.
absolutely. Uh yeah, so anytime I go into a mortgage or I'm explaining to a client or a real estate, partner, I like to talk about the three pillars. How do we qualify someone? How do we work, figure out what the box is, and then how do we think outside of the box to get them to qualify? And you have to figure out what the three pillars are first.
Yep.
The first one is typically going to be assets. How much money are they going to be putting down, or how much money do they have in the bank, right? Number two is going to be income. Okay. This could come from tax returns, a W-2 job, could come from commissions, whatever it is, but determining what income we can use, if any at all, right?
Yep.
If any at all. And then number three is going to be your credit score. Okay. And credit score can range from, depending on what the other pillars are, it can range from 500 all the way to 800. It just depends on, how strong the other pillars are to help offset, a lower credit score.
And so these different programs are going to the pillars or the minimums of these different pillars are going to vary by these different programs, right? That's one of the
Correct.
things that
Yeah.
we would do with your clients who might be exploring one or more of these programs is explain the differences of what the minimums or what the criteria are for each of these pillars specific to that program. And the income pillar in particular is a lot of these programs are unique ways to meet that pillar, right? So instead of just the typical, tax return or W-2
W-2.
income, there are other ways that we can address that pillar in particular. And so that kind of leads us into the first of the nine different programs that I've got lined up for us here, which is bank statement programs. So what do those look like, Jordan? What are how many bank statements, like how many months of bank statements? How does that break down?
Again, it's based off pillars, right? So, traditionally the higher the credit score, the less amount of bank statements you need.
Yep.
There are bank statement programs out there that are just, 3 months and up, but the requirements are different, right? If I'm doing a 24-month bank statement program, okay, I'm going to get 24 months of their bank statements. I'm going to average out their deposits, and we'll usually use an expense factor of some sort, depending on what kind of business they're in. But essentially, what we're doing is we're trying to gauge some sort of income that we could use, right? And it's fairly, businesses. I mean, banks understand, as a business owner, and as most of you are, you're writing things off on your taxes, right? You are trying to benefit yourself the most in the terms of tax breaks you possibly can. And that's why they're using this alternative type of income verification. It's just basically, supporting, making sure your deposits are supporting what you're saying, how much money you make. And as long as they do, and then they usually cut that in half, and then that's what the number we use. That's the norm.
So a couple of things on that. Number one, it's kind of a sliding scale with a lot of these programs as it pertains to like risk reward. So the lower the score within the range of acceptable scores, the more other documentation it may require. The
Or
higher the
money down,
score,
or more money down.
or money down. Exactly. Right?
I can give you a very specific example of a bank statement loan that we're doing. We just stopped it. I think we talked about this before. I do give people credit direction, and I help them fix their credit and, get them in a position to buy. We had a client that was about 40 points. It didn't quite fit his criteria and what he was needing to do to pull money out of his house. So we fixed his credit. We did a rapid rescore, boosted his credit up to a 680, which allowed him to pull a higher loan to value out of his house than at the lower credit score. So Doesn't mean there isn't really a hey, this is what your credit score needs to be. It's just it's more of a hey, if you have a 640, you're going to need 30% down instead of 20% down. Right? There's options. It's just they're weighing they're weighing the risk factor on these and seeing what they need to do. Same concept on shorter bank statements. They're going to require a higher credit score for the shorter amount of time that you do, to verify if you're doing a 12-month or a 3-month versus a 24-month.
One of the things that Jordan does, or our team in general does, if the bank statement or a bank statement program is the option we're exploring, we will often review and even submit the bank statements for review to get sort of signed off on what what they will accept or count towards the income before we go through all the other hoops of application and credit, whether it's a soft or a hard pull, things of that nature, just so we know up front what we're looking at from that perspective.
Yep.
Okay, so number one, bank statements. Number two, related but a little bit different, a professionally prepared P&L. Actually, hold on. So before we get into P&L, yeah, who are these? So to get our everybody who's watching here with us, get their gears turning. Who are we typically exploring bank statement programs with? Like
anybody that's self-employed, anybody that's 1099 or self-employed, typically. Yeah. My process is number one is let's find out what their tax returns look like first, right? Sometimes we can gauge it and say, like right around this time, taxes aren't due, right? Taxes aren't due yet. Sometimes I can do the math and say, okay, do we want to claim next year's taxes? How can I help them advise their tax accountant on how much we need to show? So this is a perfect example where right now is a good time to look for self-employed people to look at home loans because they can revise their tax returns to get them to qualify. Did that recently with someone, right? And I said, hey, you need to make this much. You need to show on your 2023. This is how much money you made last year, so we can offset, and then we could throw out the year prior, right? The year prior to that. Now, if we don't want to do that, then that's when we go down to, hey, let's look at your bank statement options. How much money do we have down? Because these loans typically require more money down, right? Compared to the normal 3.5 to 5% down on a traditional loan, these are going to be 10 to 20% down. But I would say, to answer your question, you're typically looking at anybody that's 1099, self-employed, or even people that might have a W-2 job, but they owe side businesses. That are taking losses on, or real estate they're taking losses on. It just depends on what those tax returns look like. Okay, so I'm looking at real estate investors, you name it. Now, sometimes DSCR loans are better options. And we'll get into that later. Yeah, we're going to get into probably. But just depends on the situation and how we can guide them to what is the cheapest and vehicle for financing that we possibly can do.
Yeah. With any of these programs, the value or part of the value that we offer is the ability to take all of the puzzle pieces and find the best way to fit them together. And oftentimes we're working with clients that the reason we're getting the opportunity to work with them is whoever they were trying to work with before wasn't either willing or able to figure out how to make the puzzle work. And so because in many cases, if one piece doesn't fit, quote unquote, then we just throw them aside and try to find someone whose puzzle does fit together perfectly. That's not the approach we take. We're looking at all of the pieces and trying to figure out how can we make this puzzle fit together in the best way possible. And if we can't right now, the example that Jordan gave, what can we do to make the pieces work? For example,
what's the closest thing on getting where we're trying to go? What is the closest pillar? The way I look at it is by pillars. Is our credit good? Okay, great. Is our assets good? Okay, great. We got to fix income. What do we need to do to fix it? How do we get it there? And a lot of times when you're building pipelines, that's what it's about. It's not, I don't think originators look at mortgages, but you're building your real estate agent partners pipelines is what you're doing. And you want to build it the right way. And that's setting people up to not just credit people, but everybody that doesn't qualify as, you know, you need to give them some sort of plan of, hey, you need to get here to get here.
Yep. These first three are very related, right? So first is bank statement. The second one is a P&L, a professionally prepared P&L. This would be for business owners. This would be, you know, it's not something that they can just draft up on a spreadsheet. It has to be professionally prepared. But it's an an alternative to bank statements would be using this to what's the word I'm looking for? To address the income pillar, right? Yeah. It's just a different way to address that pillar.
Traditionally, P&Ls also do require at least 2 months of bank statements to corroborate the P&L you're writing. Yep. But there are P&Ls out there that don't require that with enough money down. You know, so if you have the right money down, I mean, really in all loans, right? If you have the right money down, they kind of waive some of these requirements. Yep. Now, I like that you were to use professional, because a lot of people think CPA. Doesn't have to be a CPA. Could be a tax preparer. Could be I don't know. There's a list. I would have to get the list.
Bookkeeping service.
Yeah, something that is like, hey, you know, it's a normal. You're going to someone that is, you know, helping you with your taxes, kind of thing. They're a licensed individual, or you know, sometimes they're not. You know, but like a licensed tax preparer is a very common one that they'll write up a P&L because they deal with your taxes, or an accountant, right? Could be an accountant. Doesn't necessarily have to be a CPA, you know, specifically. But so I like to use that word because a lot of people think CPA, I need a, you know, top of the line kind of person. You don't. You need someone that does it for a living kind of thing.
Yep. Number 3, 1099s. Again, related. For example, I get a 1099 from eXp Realty every year. I could use.
So this is a unique product. I really like this product for real estate agents or anybody that is a contractor. You know, that not necessarily someone that is multiple 1099s. So like some contractors, like subcontractors, they'll have 1099s from 20 or 30 different places. That's a little bit harder to do this on. Where if it's like a real estate agent, you're typically 1099 from the same company, right? You're not really usually working for multiple brokerages. Now, with that being said, these are very easy. If you have the right amount of money and the right amount of assets, this is one of those loans that is kind of like I think are a walk in the park. You just take the 1099 to divide. That's all you do. So they take the gross of those, and just use that. So I do really like this product. I don't get to use it enough, I don't think, but it is a great product.
So one thing I'll say before we get to number 4, right? So far we got bank statements, P&L, and 1099s. Before we get to number 4, one of the reasons why I like sharing this information is not necessarily the fact that, you know, the client that you think this will fit, that it'll actually work for them. Meaning this is more to help you continue to be able to open and continue conversations with more clients. And when they bring up a potential objection or reason why they can't proceed, whether it's with you or just in general, having having the tools in your tool belt or the bullets in your chamber to be able to address that, to at least continue the conversation, to get them to engage with us or with another mortgage partner to see if that will work. And in many cases, it won't, but there might be a better solution for them or a different solution for them, right? So it's not, just because one of these really resonates with you and you start using it in marketing or in follow-up communication, et cetera, it doesn't mean that everybody replies to that is going to go that route. And I'll give a very specific real estate example. For years, we used the idea or the offer or the marketing hook of foreclosure properties available in blank area, right? Get a free list of Central PA foreclosure and REO owned homes. Well, the majority of the people that replied and opted in for that that ended up buying a home did not buy a foreclosure. It's just what started the conversation or got their interest. Same idea here. We're just giving you ways to create intrigue and curiosity and get a conversation going. And then we can have the opportunity to identify what is going to be the best path forward or the best program for them to achieve whatever goal it is they have their hearts set on. Number 4, ITIN. ITIN.
Mhm.
Jordan, what do you have on this
So
program?
illegal immigrants, essentially, undocumented, or maybe they had a visa expire, right? There's a lot of times I would say 90% of the time visas are just expired and they just have to renew. But it's a product that allows them to purchase,
Yep.
essentially. We use the ITIN number to qualify them. So ITIN is just a federal number for them to pay taxes. Okay,
Like
that's all it
it's
is.
like a social security number for those
Yep.
of you that don't know. It's
Yep.
pretty much
So when they get a visa, they get assigned this ITIN number. And when they have the ITIN number, and they're assigned it, we can use that as their credit, essentially. Okay. And these are usually at least 10% down. The norm is about 15 to 20. In some cases, I've seen, lenders out there that will do 5, but it's a nightmare, right? It's 10 or more is much better.
yeah.
Okay. And they hit them real hard,
Yeah.
at 5%. So
For many of you, that might not be relevant at all, but for some of you in your market, it might be relevant. And you may that this idea alone and the fact that you can help folks that fit into this box, that might end up being 4, 6, 10, 12 extra transactions in the next 12 months if you choose to own that or to make that your niche or the the client audience that you are catering to. Related, but a little bit different.
we had a question. We
Foreign
had a
national.
question, Josh, on the
Yeah,
last one.
go ahead. Yeah,
So in the qualification, purposes, typically we want to see a 640 credit score. When we say credit score, I realize a lot of people think Social Security number. The I-10 should have a credit score that's attached to it, right? They use that. They have to be done. It has to be at least 2 years old. Okay, that's the other caveat. As a lot of times, is the norm is 2 years. And when I'm making these qualifications, right, and saying, hey, this is what the norm is, doesn't mean that we can't do extenuating things. So what I mean by that is if I have an I-10 putting 40% down, that's a different story. Credit scores are going to drop, okay, as well as they might not need a credit score at all, right? In
right.
those situations. So keep that in mind, right, when I'm saying normal. But typically it's 10% down. If we 5% is out there, but the points and fees on it make it about 10% anyway. So, you might as well go to the cheaper route. But it's a good product. I've done many of them and they're solid.
Yeah, foreign national.
She's asking a question, right? Exactly what we're talking about. It's foreign nationals.
Oh,
So
okay, perfect.
foreign nationals, typically 20 to 25% down. It's ran like an investment property or a second home. Okay.
Yeah,
These products, will qualify them based off of national, foreign national income as well as bank statement. I mean, there's a variety of ways. Think about it this way: foreign national is just a type of person. Doesn't mean there's not a foreign national bank statement program. Doesn't mean there's not a foreign national P&L. Doesn't mean there's not a foreign national DSCR loan. This is just explaining that this person is not a U.S. Citizen. They don't live in the US and they are investing in here. Okay. So typically 20-25% down. We want to see international, credit, things like that, or no credit at all, depending on the down payment.
yeah.
But it is a product that you can absolutely do.
And this is another one where there may, you may be in a market where this literally is not a thing at all, right? There's no, there's
I'm gonna just be honest with you guys. I live in Wichita, Kansas. I've never done one in Wichita, Kansas. It's always been
right.
in Florida, Georgia, East Coast, West Coast states.
And also, Adele said, "I'm very interested in this." So, Adele, I'll be happy to connect you with Jordan so we can get get to work on some of these for you and with you. She said in Florida and Georgia, we're licensed in both of those, so we're good to go there, and we'd love to explore further. So, number 6. We alluded to these a little bit at the beginning. DSCR. DSCR, for those that don't know, the acronym stands for Debt Service Coverage Ratio. Debt Service Coverage Ratio. We do have a specialist on our team for these. His name is Taylor, and we'd love to introduce you to him if this is of interest to you. But Jordan, could you give an elevator pitch on DSCR loans?
DSCR loans are made for investors, right? They're made for investors to make purchasing homes easier. We don't have to hold their debt load against them. It's all about the property itself. Okay. So I have one right now that's going, a duplex. Okay. And we ordered the DSCR. The payment on the duplex was about $2,200 a month. The DSCR comes in at $2,700. So it's over a 1-to-1 ratio. Basically, it's saying for that area, you're going to make money, right? You're going to at least break even. So the norm is a 1-to-1 ratio on these. So if you have a payment for $1,500 on a single family residence, for example, or $3,000, whatever, it depends on the market and how much you're buying. But let's say it's $3,000. And as long as the appraiser will go out there and they'll fill out either a 1007 or they have a lease. A lot of companies will use the higher of the two. So let's say the property is already rented at $4,000. Okay. That meets the DSCR ratio. It's at least a 1-to-1 ratio. Now, with that being said, that doesn't mean we can't go less than a 1 ratio. We even have no ratio DSCRs, but it's going to have a higher rate, a higher down payment, so on and so forth. So essentially, where investors would struggle with Fannie Mae, Freddie Mac investor products because they would own a ton of homes, and then on their taxes, they're either taking losses on renovations or taking losses for whatever reason. This would alleviate that.
And two things on that. You glossed over 1007. Some people might have been like, wait, what was that? What does that mean?
Okay. So 1007 is it's in a form an appraiser will fill out. It's just a rent market analysis that the appraiser will complete. Okay.
So instead of a comparable sales appraisal, it's an appraisal based upon the rental value of the property.
Yes. Is that comparable rental values for similar properties in the area?
Yeah.
Now, with that being said, on the terms of like what are our pillars on this? Typically, you want to see 20% down, at least a 640 credit score to open up to most banks. Yep. The higher, the better. But again, we have products that will go down to 580 with enough money down, right? There are lenders out there that will.
We also have lenders that'll do 15% down, but it gets tricky to fit the other qualifications. It's harder to get it to ratio to where it will get approved, and there are, generally speaking,
credit scores like 740,
higher fees,
higher rate, higher fees, exactly. Which would offset on whether or not it makes sense. So if someone's charging you 4% in fees, for example, and you're putting 50% on, you're already at 19%. Might as well put another one, kind of thing. Yep. So sometimes I personally haven't done one because the pricing, it just haven't seen someone fit the box and have the right pricing. To get
when Jordan says haven't done one, he said he's meaning hasn't done an 85% LTV.
15% down. Sorry.
It exists. It exists.
Yeah.
In fact, I just got an email about one about an hour ago. So it exists, but it's hard to get them to fit inside the box. And honestly, most often we can find other strategies for even getting them down to a 75% LTV where they're making up maybe another 5 to 10% with equity in another property or some other means that will just mean that the numbers work way better, right? Where it just makes more sense as an investment. And before I move to number 7, I just want to really emphasize one point here: debt service coverage ratio. It's the income of the property, which means the income or the employment of the borrower is not necessarily relevant. Okay, so I know that kind of states the obvious, but for these loans, when we talk about the income pillar, the income is from the property. That's the means of addressing that pillar with these kinds of loans. Okay, And if you'd like, if this is something that's of interest to you and you want to explore in more detail, let me know and I will connect you with Taylor, who again is our specialist. He's working on these every single day. He's been in this side of the business for over 20 years. DSCR is a relatively new acronym, but these types of loans and not just DSCR, but also fix and flip or hard money. Taylor's also kind of our specialist on this. So, Jordan, what are these? What's the use case for these types of options?
Again, investors
Yep.
that are want to fix and flip properties, or even maybe fix and hold them.
The Burr method.
Yeah, the Burr
they
method.
can use this to acquire the property and renovate
it, and then we
Yep.
can when it says flip, they don't mean necessarily sell it, refinance it. You could refinance it too. Just get rid of the loan.
Yep.
They're short-term loans, usually in year. There's usually not income qualified on these. These are like no income loans. So, we're not gonna, figure out how much my investor has money. They're gonna look at the deal itself and what their
Yep.
projected plans are. There are in situations, a lot of these lenders want to develop relationships with these, fix and flippers, right? These are something that's happening over and over and over again. So your terms as you do projects and you build your portfolio, I tell people that are just starting out flips, document your portfolios. Make sure you have a great binder that you can show people, show these investors, because as you document yourself and the more professional you come off, they will give you better terms. I have a lender that will go 100 after 15 flips. Okay. That means there's no money involved at all from the buyer. They can buy as many properties as they want. They'll give them 100% rehab and they'll do it for them. But it takes someone that is doing this professionally, right? It's not someone that is, hey, I'm buying a house for mom and dad and we're gonna renovate it and flip it and not document any of our process, or they got to be put together. So I try to get everyone to aspire to that.
Yep. It's got to be your business, right? You're treating it like
it's got to be a business. You got to take it seriously. But I try to guide everyone to aspire to that, because it's by far the easiest for us and them, and the cheapest, surprisingly. It's quite costs them quite a bit less money too, because they work with a lender often. Now, with that being said, what you're going to see normally wise is 20% down, 20 to 10% down normally. These do allow less than 20% down, even though they're investments, is because they're very short-term loans, very short-term, and you can get rid of them very quickly.
Two things with this, 100 to 100. When Jordan said that, he meant 100% LTV and 100% of the renovation costs. That's how you can get into them with experience, and by documenting that you're successful at this, how you can reduce your risk or your capital outlay over time. And once again, these types of deals are more about the deal. If you have a great deal, it is much easier to find good options versus a deal that's maybe, or it's marginal, or some would describe it as thin, right? Where the margins are thin. It gets, there are less options, and the terms are typically more onerous on the lender side. But if you've got a great deal, there's money available. There's money available. Number eight, no ratio, or no income, no employment. So we do have programs where the income pillar is irrelevant.
Mm-hmm.
Now, that said, the other two pillars become even more important. So, Jordan, what does that look like?
We have one lender that does this. I've closed many of the home loans, but this is for primary residence. So usually no ratio, or no. When you hear the term no ratio, typically they're talking about DSCR or they're talking about a different product. This one particular, we're talking about a primary residence. When we say no ratio, we mean we're not calculating any debt to income ratios. So it requires a 700 credit score. That's one pillar. Okay, 700 and above. Yep. Number two is going to be at least 20% down. Okay, minimum 20 to 25% down. Okay, and then number three is there's no pillar for income. So that's all it takes. So
Yep.
typically these are also have a certain number of reserves in your assets. Okay. So not only it's 20% down, but it's going to cost another 12 months of reserves, or basically 12 months of payment stacked up. So this is really reserved for those people that have money, lots of money, but don't have any other way to buy a house because they don't have enough to do an asset depletion loan, or qualify based off a trust. If we put money in a trust, there's different ways I can move money around to get people to qualify for traditional products. Maybe they just don't quite have enough, but they have enough to do this kind of product. It's kind of that in between. Hey, I don't have an enormous amount of money, but I do have enough to purchase something like this.
And the reserves don't have to be, cash in a checking account. They can
It could
be,
be
you can document reserves
stocks.
in many different ways.
Yeah, stocks. It could be 401k. It could be anything, right? It could
It
be.
can even be cash from a cash out. Like we have, here's an example of where we used this type of mortgage for a client. They did a cash out refi using this. The cash out met the reserve requirement, and they took that cash and bought a second home. So instead of getting the financing, it just made more sense. It was easier for them to cash out a home that they owned free and clear, or nearly free and clear. I don't remember exactly, but it was enough cash to then use that cash that they were pulling out to purchase the new property with that, with that cash that they pulled out, with that equity
We
that they
just
pulled out.
we essentially leveraged a different home, right? So to you guys, it's a cash purchase. To us, it was a refinance, right? We've refinanced another home to give you the cash to help you that client buy a cash house for you.
The last one I had on my list, and I'll give Jordan an opportunity to maybe cover any that I forgot about or missed. But the last one I had was something called an all-in-one mortgage, and this one really, we should do a deep dive just on this one on an upcoming session, because this is a potentially really powerful financial instrument
and it's
for the right
complicated too.
clients. Yeah,
It's complicated too to try to explain to people. So I'm going to do my best to try to
yeah,
explain it in a short time.
yeah.
It's a simple interest loan is a best way to describe that. So essentially it's not compounding. Okay. It's the interest is redone on it I think it's every day or month. I'd have to go back and look at it, but I'm pretty sure
I
it's
think
every
it's
month.
daily. I
It's
think it is daily.
something like that.
Because that's part of the strategy, is to keep the minimum balance as low
Yeah.
as possible on a
So
day-to-day basis.
think of it as a checking account on your house. It's technically a HELOC, a home equity line of credit, but it's a first lien mortgage. So basically, there's no other mortgage on it, and it's open for 30 years. I think it's a $65 fee to keep it open per year. And essentially you can draw from it at any time. So what I mean by that, you get a checkbook. Okay. The best way to describe
And
it,
a
you get a
debit
checkbook
card.
and a debit card, and
Mm-hmm.
you can swipe it for groceries. And then the idea is to put everything on into that checking account. So when you put money in that checking account, it instantly goes against the house. And since at any time you should be making more money than you're outputting, hopefully, hopefully,
Hopefully.
if anyone's used, I like to use the reference as if has anyone used like points on cards and paid it off every month. It's the same concept, right? Instead of getting points, you're saving interest. You'll pay this loan off in 9 years, usually for most people on average, just because of all the interest you save. So instead of getting points like on a credit card, it's the same concept. It's just you're not going to get paid interest because you're not going to get charged it. It recalculates the interest on a daily basis. So in theory, people will pay like the rate on this is the same as the market rate. So if rates are 7%, it's going to be 7%. But in theory, that is over a 30-year of you never paying but the minimum, right? That's what that interest rate is expressed as. So if you're paying X amount of dollars into this every single month and it's recalculating it, you're probably going to average out to 3 to 4% or less, depending on what rate you get.
Yep.
Right.
So it's a first position
or
HELOC.
how much money you put in.
It's a first position HELOC that kind of acts like your own checking / credit debit account. If this is something of interest to you, we'd be happy to explore in more detail. We'll probably do a deep dive just on this, but we're just whetting your palate for these different programs. Go ahead, George.
Yeah. The other thing that you have to understand about this product is this is really good for investors. They don't need me anymore once they have this product in theory, right? So if an investor is trying to pay down a house quickly, or they can do this for investment properties where you're putting the rent to the house every single month, right? And they have access to that still. That's the big thing is typically investors have to do a full refinance to have access to their equity. They have to get a HELOC. They have to do something. And where there's situations where, right now interest rates are higher than probably what most investors have on their first liens. They're just going to try to get HELOCs instead. This would, totally negate that. You wouldn't need that at all. So if they wanted to go out and buy a property and buy it cash real quick, they could go buy it cash, do a delayed financing on that to where they can get a better deal because it's cash. And then they could turn around and do delayed financing on it, pull the money out, and then pay it back onto the mortgage of the all-in-one loan. But these are available for primary residence, secondary, and investment properties. All three. Typically, it's 20% down. Okay. They do qualify off normal qualifications. This isn't like a bank statement. It's more of like a conventional qualification. And then number three is they're going to require at least a 700 credit score.
So number one, bank statement. Number two, P&L. Number three, 1099. Number four, ITIN. Number five, foreign national. Number six, DSCR, debt service coverage ratio. Number seven, fix and flip or hard money. Number eight, no ratio or no income, no employment verification. Number nine, all in one. And Jordan, did I forget any that we should include in this list? And as Jordan, I'm putting Jordan on the spot. If you have questions or thoughts or scenarios, you can drop them in the chat, and we'd be happy to address those.
No, I mean, there's not. I mean, we pretty much cover our wheelhouse.
Yeah, I mean, there's different subsets of each one, and we could really get into the weeds. But the idea here was to open your eyes and give you just different tools in your tool belt. Like I said, when you're talking with clients or potential clients, and they're using words that indicate motivation, but then they've got some reason why they can't qualify or they aren't able to proceed. It's about equipping you to be able to address that concern, continue the conversation, and potentially turn that that skeptical or uneducated, and I don't mean it in a negative way, but just like they just don't know what they don't know.
I mean,
and you can turn that.
Yeah, I mean, with that being said, Josh, how many times have you heard from self-employed people say, "Oh, I don't qualify.
Exactly.
I don't qualify because of my taxes."
They just assume. They don't even. I mean,
they've been told
they have this sniff.
They've told it once, and that's a common thing.
Right.
That's probably my most common rebuttal from self-employed people.
Yeah, where they went to the bank where they have their checking account, and they were like, "Oh no, we can't help you," and so they assume that means no one can help them, and that is the farthest thing from the truth.
Yeah.
So okay. Well, here's what we're gonna do. I want to wrap it up with some housekeeping items. Number one, I shared in the chat Jordan's contact info, my contact info, Taylor's contact info. Number two, we've got info on the screen here as well. You can scan the QR code top right if you're interested in our dual license program, where you can be dually licensed as a real estate agent and a loan officer, which is that's the criteria, or that's the bucket that I fit in. I've been dual licensed now for just over 2 years, and took me a while and finding the right people like Jordan to make it work, but it's working beautifully now. And being able to have multiple revenue streams from one client or one transaction is well, it's a beautiful thing. And if you want to explore that, you can scan that top right, watch a short little video, or just reach out to me and schedule a time for us to chat. Bottom left is if you or yourself or you have a client who you would like to apply, you can create a free account and start an application right there. We don't have to do a hard credit pull or anything like that to at least preliminarily review the application and get an idea of what direction we might want to go in, and then next best steps depending on that direction. So you can check that out. As I mentioned at the beginning, we set these up so that they are available immediately afterward on demand. So the same link that led you here, you can check out the replay. We also take the replays and we add them to our YouTube channel, Wake Up Real Estate on YouTube, and our website, wakeup.realestate. So you'll see those, the replay live there in the next 24 to 48 to 72 hours, something like that. If you want to go back and review, we always welcome conversations, questions, scenarios from you who spent time watching this today. So don't ever feel like it's a burden or that you're bothering us. It's what we do, and we are more than happy to chat with any and all of you to see how we can help you help more clients and therefore sell more homes and therefore increase your revenue and survive and thrive amongst these changes that seem to be coming at us fast and furious in the industry. So, Jordan, thank you, sir. Appreciate your time.
Yeah.
Great stuff as always. We'll be back next week, and I'll have it buttoned up by the end of the week or early next what our topic will be. But we'll be back again Tuesday at 1 Eastern, and hope you'll join us for that. In the meantime, if there's anything we can do to help you or any of your clients, we'd love to chat. Take care and make it a great rest of the week.